topic you have on the board. You are solving question on each and every topic you have on this board. That means we have to cover the whole syllabus. That's why it is called what? Revision. Okay? But before we start solving questions, give me how many minutes? 10 minutes. 3 minutes. 1 minute or one. I'm going to say something about UK tax system, income tax, corporation tax, CGT, VAT, IHT. Just to refresh your memory before we start with solving questions. Okay, the UK tax system. Remember, I said this question is what? This thing is what? It is strictly what? Calculation. But that's notwithstanding, you have to know what you're doing. Okay? You can see now the other things. You need to know what you're doing. Why are you doing what you're doing? Remember, we are in the UK, and this is UK tax system. And what do you think taxation is? Why do governments impose tax? Majorly is to generate revenue. And what do they use the revenue for? To do what? Then we split it into what? 3. We have social reasons. We have what? Economic reasons. Then we have what? Environmental reasons. I don't want to go in details. Okay? But one thing you need to realize is that the government wants to encourage some things. Another thing, they want to discourage something. One of the things they want to encourage is what? They want the citizen to cultivate the habit of saving. Okay? Another thing, one of the things they want to discourage, tell me, give me one. Is what? Alcoholic and cigarette smoking. So how do you think they use taxation to control this kind of a thing? It's very simple. By the way, if they want to discourage, they will impose higher tax. If they want to encourage, they will reduce the tax. Even they might even go to the extent of granting the company what? Grants. Okay? Then, another thing, can anybody remember any other purpose? Then we talk about different type of tax. We have what? Direct tax and indirect tax. Direct tax simply means what? You as involved, you are what? You are paying the tax directly to the HMRC. Okay? Then indirect tax, from the word indirect, there is what? An intermediary between you and the HMRC. Okay? And here, income tax is a form of what? Direct tax. Corporation tax is a form of direct tax. CGT is a form of direct tax. VAT is what? An indirect tax. IHT is what? The mixture of the two. You know why? Why? Okay, when we get to IHT, I will let you know. Who pays IHT? We is what? You can see donee or the donor. Even the donor himself. Who is paying? Who is suffering this? The donor is not the one paying for chargeable lifetime transfer. It is the donee that is paying. But who is the donee here? We say it is the trust, right? But is the trust the owner of the property? No. Who is the owner? The beneficiary. Do you get? You can see it like the form of what? Indirect tax. Okay, don't worry. We'll get out. Let me stop it now. Income tax. What is income tax? Like we just said, that is a form of direct tax. Okay, and the income tax is a tax that is being imposed on what? An individual income. And this is where we have a lot of things here. Okay? Right here. We have a lot of things there. Income tax, like we said, is a tax on an individual income. They didn't say it's a tax on your salary. They didn't say it's a tax on your what? Profits. What did they say? Income. Income simply means everything you are earning. In as much as what? You are earning, you will be taxed. Okay? And like I said, because of the fact that we could have what? Over 1 billion source of income. That's why they come up with a non-savings, savings, and dividend. And you know what comes under non-savings. Okay? One of the items you have under non-savings is what? Employment income. Okay? And we said what? I analyzed what an employment income is. What is an employment income? It's an income you derive as a result of what? Contract of service. Right. What's the difference between contract of service and contract for service? You're self-employed. Okay, that's right. Then we'll look at those traits. Can you remind me? I think we use control, right? Okay, risk involved. Okay, if you're taking more risk, if you're not taking more risk, that means you're the owner of the business. Although everybody takes risk as far as any organization is concerned, but who bear the most? Who take the most risk? That's what we're looking at. Okay, that's just by. But I need you guys to go and learn that thing, please. We use control, right? Was it control or contracts that we use as the abbreviation? I think it's control. Okay, the first one is contract. The other one, O, is what? The other one, you know the. Are you this? You know what we're doing now. What I'm trying to say is, no, because I want to. You said? It's like, yes. Please, you are not. Let me come and look at this. Circles, okay, high. Integral parts. R, risk. C, contract. Control. The first one is contract. Then L, legal. Right? E, equipment. Okay, please go and learn this. Learn it. And it's very simple anyway. We talked about contracts. Integral, if what you're doing is integral parts towards the core business of the organization, then the other one, risk. Who bear the most risk? The other one is control. Can you decide where to work and how to work? If you can do that, that means you are the owner of the business. The other one is legal. Okay? Then the other one is equipment. We talked about equipment. If you are the one providing the equipment that you're using, if you're the one, that means you're what? You are the boss. Okay, that is that. Then we'll now move to how do we compute employment income? How do we compute employment income? Remember, your salary is just what? One out of the what? Several items that make up your employment income. Your employment income is all there, all your emoluments, everything put together. Okay? You have what? You have employment, you have salary, you have bonuses, you have commissions, then you have benefits. Okay? You have benefits. Now, when do you recognize salary? At the end of the month. As it's when it ends, that's when you recognize it. Okay, how about bonus? When declare? You just say when declare. When the benefit? No, I said bonus. We are not even bonus. When it's paid? Is it when? It is. I expect you guys to be the earlier of. That's what I want. The earlier of. That's just by the way. Now, I said, when do you recognize bonus? I say it is the earlier of what? When it is paid and when it is determined. That's for ordinary what employee. They will now went further and said for directors, because directors are in a position to influence what? One of these decisions. They can determine, they can influence when the bonus will be paid to them. So they now had additional information that is coupled in addition to the two. When it was thank you. When it is decided at the board meeting, or when it is what? Credited to the company's accounts. Okay, that's when you recognize those people. Okay, the other ones for benefits. We have two types of benefits. Hope you know that. We have tax-free and what? Taxable benefits and exempt benefits. Exempt benefit, that's what I mean by tax-free benefits. So don't do that. Which one is tax-free again? Okay. What I known to unknown. The exempt benefits, what are they? Exempt benefits. There are so many rules. Just mention them. Maybe I should ask you guys to give me one because exam is 2 weeks now. So you I want
that is not exceed 8,000.
£8,000. Pounds. Okay. Everybody. Can't even think of anything. Okay, dear children. I'm getting this one. I'm not finding I can't. That's correct. Then the other one, there are so many rules, that I can't even think of anything now. And did you know that loan of 5,000 is tax free? Below 5,000, irrespective of the interest you're paying, it's tax free. That's like what we call diminished loan. Irrespective of the interest of it is tax free. You won't pay any tax on it. Okay? Any loan above 5,000, and then that's when you now determine whether you are paying the official rate or you are not. Okay, that's for tax free or exempt benefit. How about taxable benefits? For taxable benefits, there are some rules. Mention them. We have car benefit, house benefit. Not just you mention. I hope you know what they mean. Okay? What benefit simply means is that you are enjoying what you are supposed to pay. You are not paying for it. Some other person is paying for them. Do you get? It's a benefit. Ordinarily, you are supposed to be the one that will do what? Take the money from your own pocket and buy them. Okay, that's what we have. Taxable benefit. And there are some because we have medical insurance, which is what? The premium. Don't forget. It's just the premium paid by who? By your employer. Irrespective of whether the insurance company has spent 1 billion in doing anything, it does not matter. This is just that insurance that the premium that your company has paid. Okay, then we move to which other one? Give me anyone. Any taxable benefits now? We have car benefits. When your company provides you with a car and you're using it for private use, okay, that's when you have car benefits. And how do you normally do it? Don't forget the list price minus if you have any capital contribution of what? How much? 5,000. You forgot to. Okay? Minus 5,000 capital contribution multiplied by the official what? Rate depending on the CO2 emission. I hope you still remember how to compute that. Don't worry. We'll solve the question on that one. Then another one, 4 benefits. Where it is the government that is selling the car. You know what to do. You have to conclude the 4 benefits. But if you are the one selling the car, you don't have to do anything. Do you get? Okay, and please don't forget any benefit whatsoever. You have to look at the time in which the benefit is being provided to the employee. So that you do what you have to time a portion. Okay? That's that. Another one. We have loan benefits, we have transfer benefits, use benefits. Accommodation benefits, accommodation benefits. For accommodation benefit, there's one thing I want you to realize that we saw the question in the last class on accommodation benefits, which is how do we normally do it? We say the basic charge, which is what? The higher of rentable value and what? The annual value. Okay? Now, we now say if the accommodation is an expensive accommodation with a clause. If it is what? It is the company that owns the accommodation. Please watch out. The company might be renting the accommodation, but they will give you the market value. You don't have anything to do with the market value because it's a rentable property, not a free-owned property. But if it is a free-owned property, you now have additional charge, which will be what? The cost of providing the accommodation minus what? 75,000 multiplied by the official rate, which is 4%. Okay, are you good with that? And what is the cost of providing the accommodation?
The market value.
Okay.
Or the cost of providing the market value.
Okay. It depends. This is where I need you guys to pay attention. It depends. No, you're right. I know you understand the principle. How to put it, you don't know. No, you're right. The cost of providing the accommodation is A plus B. Now, what is A? A is what? Is the cost of providing the accommodation. Now, if the accommodation had cost to your employer, what? If your employer had acquired the accommodation 6 years, more than 6 years, before giving you, the employee, the what? The property or the accommodation. Then what do we use? You're going to use the market value as an date of gift. But if it is still within what? The 6 years, you use the what? The cost to your employer. Okay. Then the B is what? Is any enhancement, any capital expenditure incurred prior to what? To the current tax year. Are we still on the same page? I hope I'm not on a different page. Okay. That is that. Then we move. Please don't forget, we have job-related and non-job related accommodation. What is a job-related accommodation? Like a caretaker, I like that. If in the example, remember I used this balance as the example. So you're looking, okay, balance. That's customary. Do you get? It's one of the customers. Another one for security purpose. Okay, those are the reasons where you have job-related accommodation. And please don't forget, for job-related accommodation, you don't need to bother yourself calculating what the accommodation benefit itself. However, remember, when you are computing the accommodation, you are not only computing on the building, but on other things inside, like what? Furniture benefits, like used benefits, television, computer, all those things. You have to consider them. At what rate? 20%. Okay, that's that. Let me also wrap there. Then, implement income, what other thing do we talk about? Nothing. Okay, that's what makes up our implement income. You had it. Okay, you take it to non-savings income. Are we good? Okay. Then from there, we'll move to our trading profits. Trading profits. Remember, we said this is one person, a taxpayer, that has both works. He's working and he has his own business. Now, we want to deal with his own business now. How do we do it? As a one-man business, say I'm an accountant, yes, a chartered one for that matter, but I have a business of my own. But that will not stop me from preparing the normal accounting income statement, which will be what? An income statement that will, on it I will have bank interest received. If I dispose anything, I'll put it there. Do you get? If I pay anything, I'll put it there. The only thing I'm interested in is just the net profit. But as a tax person, we are not just going to take the net profit that you've given to us, because there are some things you would have done which ordinarily you're not supposed to do. Do you get? Which are what? The alliables and non-alliables. I only have 4 adjustments to do. Once you understand those 4, you don't have any problem. Let's come to expenses. Now, expenses which you're not supposed to deduct that you've deducted, what do? You had it back. Income which you are not supposed to add that you've added, what do? Income that you're supposed to deduct, income that you're supposed to add that you've not added, what do? Expenses that you're supposed to deduct that you've not deducted, what do? Once you understand those 4 principles, you are good to go. Okay? Now what do I mean? There are some adjustments that you would have done. Say you incur on expenses both for private use and for business use, everything will just charge you to your home. Depending what you're going to do on that transaction will be dependent on what? Whether or not you've done something before. If you have not done anything before, you just do what? You had the business purpose. But if you have removed everything, what do? You remove the private purpose. Just like that. Okay? And one of the items that is mostly you always see in the question is depreciation. You had it back. And in place of that, what do we have? Capital allowance. Then we now need what? Capital allowance. What is capital allowance? Capital allowance is an allowance in lieu of what? Depreciation. An allowance we get in replace of depreciation. And remember we have what? Different headings, okay? We have AIA. What's AIA? Annual investment allowance. Of how much? 250,000 pounds, okay? Now, items qualifying for AIA, what are they? Machineries, armor van, every other thing, everything with the exceptions of what? Motor cars. Okay? Now, we did this thing and I keep saying, I don't know, I'm disgrace. How about if you have, you know, we have special rates pool anyway. We have special rates pool, we have main pool, then we have FYA. Right, what's FYA? First year allowance. Then when you acquire a car that emits less than 90 G per km. Is it 90 or 95? 95. Okay, 95. Okay, it goes to what? FYA. Okay? Cars that emit between 95 to 130. What do you rate it? Okay, car rent above that, what do you do with it? Let me pause here and go back to that adjustment of profits. Now, if you have acquired a car via lease, you know what I mean by that? You have the use of a car via lease. What do you do if the cost of the car, the CO2 emission of the car that you get is this? What do? You do what? The CO2 emission. Look at what you're doing though. It's not an outright purchase, but you have the use of a car via lease. That's lease old car, not free old car. Thank you. You know when you lease a car, there's every tendency that you are using it 100% for your business purpose. Okay? But the law now says anytime, just look at the CO2 emission. You would have written up the cost normally in your book as an expense. But what I say, when the CO2 emission exists, it's more than this. You need to disallow what? 50% of the lease cost. Did you get it? All you just need to do, you look at it. What's the CO2 emission of the lease? Did you get it? It's more than that. That's what you do. Okay, that's by the way. Then we now move. We talked about what? Business use. Okay? Business use. Anytime you have any what? You have assets. You have assets that you're using both for private and for business. What do? You keep it separately, especially motor cars. You keep it separately. You don't pool it. You don't put it in the pool. Okay, now what's WDA in the pool? Main pool. 18%. WDA in the special rate pool. 8%. You guys are hot. Okay, now how do you adjust our what? When you have short accounting period and long accounting period, what do? You prorate, yes. And tell me those items that you don't prorate. FY1. You prorate the IA. It's only FY we don't prorate. Esu. How about balancing allowance and balancing charge? Do you prorate that? No prorate your balance. No. I said the only time. Remember, I said if you have assets separately, if you have them kept separately and you dispose those assets, it will give rise to what? Balancing charge or balancing allowance. Now the only instance where you get to have a balancing charge in the pool is when? At cessation. Because at that point in time, the business is what? It's season. So you have to dispose of everything you have. Are you there? I think we can pause it. Capital allowance. Okay. Then what's the other thing? You're good to go. Let me tell you something. There's no way you can run away from capital from everything I've been mentioning now. Okay? Now let's talk about, I'm merging these two together now. So when I get here, I won't have to talk about it again. For capital allowance, for companies, how do you apportion for a company that has long accounting period? 12 and the remaining one. Okay. Now, how do you take account of private use for companies in capital allowance? Private use of assets. How do you take account of it?
You forget that
You don't do what? Thank you. I understand. I don't know why students. Yes, we are under examination tension. 80%. Do you get? Forgetting that it is corporation tax that you're doing. Please, just stay focused. You don't do that. You don't apportion it. The question, you always say it there. You always say it there. Unless if it is what? Say it's a one-man business. And that person is now using the asset of the business for his own personal use. Okay. At least, I remember when I didn't mention mileage allowance. So you guys remember mileage allowance. Please. Okay. Then another thing. I think I'm done here. Now the computation, normally, you have the items that you have under non-savings. Okay? Once you've adjusted your profit, you take it to non-saving. Remember we've done our employment income, you had it. If you have pension income, what is the difference between pension income and pension in this way? You're receiving. You're still building. Do you get? Pension income you're receiving. Then ordinary pension, like personal pension, you're still building, you're still saving. Okay? At the point of you building, you get relief. At the point of you taking, you will be taxed. Do you get? Is it possible for someone who is age 54 to be taking pension income, to have a pension income? For this purpose, they will never give it to you. No, you don't understand. Age 54, yes, except for this purpose, no. Because they assume you're still working. Okay, you're still building. Do you get? Okay, that is that. Please, there's one other thing I need you guys to take notes. The treatment of what? Personal pension contribution and gift aid donation. What do we normally do with it? Those two. First, we gross up. Then we use it to expand the bank. But before then, we also use it to adjust our what? Our profit to determine whether the taxpayer will be entitled to what? The whole of what? Personal allowance. Please, don't forget it. Please. Okay. Any other thing? Okay. Tell me the compression, the rates, the starting rates for non-saving savings dividend. Do we know we have? The first one that we have here is what? The basic rates. Now start, I need you guys to tell me. I need you guys to tell me, do we have any starting rate? Anything called starting rates? Okay, for savings, what is this? Is what? 10%. Please, I don't know how the examiner will do it, but please, I don't get to know it. There's a starting rate of 10%. This is for savings. Okay? But you will not have it where your non-savings is more than 79, is it 79 or 75? You say that your rate of allowances. If it's more than that, you will not have it. Do you get? Then you know the rest. The normal, the basic rate here is what? Don't get used to what I have here. In the kits, you only see these two, they will merge together. So it's just this and this that you will see. Do you get? Followed by what? The IRS, which is 40, 32.5. Then the additional rates. 45, 45, 45. Look at the exam, it's so simple. You guys have your points. There's 7.5. Okay. Now, it's not enough for you to know this rate, but you need to learn how to apply it. Okay. I know you're good at that. I don't want us to waste our time there. What's the difference between tax liability and tax payable? That's just it. That's just it. That's something that solves. Okay? And remember, there is one thing that will be given to you, but you will not have to use it when you're computing, which is what? Your payee. Every other thing you would have used them, like what? Tax on dividend, the grossed up on dividend, the grossed up on building society interest, the grossed up on bank interest. All of these things you will have used them, but for what? For paying, you will not have it. Is it possible for you to have tax repayable? So, in what case? In what instance do you have tax repayable? When you pay more than what you're supposed to pay. But you said what? Yes. Okay? When you pay more than you're supposed to pay, then you are allowed to reclaim it. Okay, that's not for your different time. Now, for corporation tax, I think students always have issues with income tax. I don't know. But corporation tax, I find it very interesting because there are not too much adjustments to make. Okay? What is corporation tax? Corporation tax is a tax that is being paid by companies, corporate entities on their profits, on their taxable total profits. Okay? Now, everything with the amount under income tax is also applicable for companies, with those exceptions, those little exceptions that gift aid donation for companies, is it an liable expense? Gift aid donation for companies, is it an liable expense? It's not an liable expense. Yes, you want to say, is it that government are trying to, government should be encouraging companies to give to charities, okay? But because when you're looking at what we ought to do, when you're adjusting your profit, you're saying, yes, what is this business doing? This business is into Gary business. Anything that has nothing to do with Gary, remove it. Do you get? So that it's okay. At the end of this Gary business for this particular tax year, this is the profit or this is the loss. Okay. However, because of the fact that they want companies they want to encourage companies to give to charities. That's why you have a line. There's a line for corporation tax. After you have your TP, your trading profits, you have your bank interest, you have CG, and you have every other thing. This is your total profits. Then you now have gift aid donation. It is on everything, not just on your profit that you remove your gift aid, you remove it on everything. That's why it's a what? It's a disallowable expense. You would have added it back in their book. Then you will now come and remove it here. You're still coming. Now once you have this, remember there's no between this is just total profits. But this one is the TTP. What's TTP? Taxable total profits. Okay? Then you now have your what? Your dividend will gross up. When you gross up your dividend, what do you call it? FII, your France investment income. And when you add this to this, what do you have? Augmented profits. Okay? Now, how do we tax? What do we use to determine the tax rates? At least you remember me the example. Okay, you use augmented profit to determine the tax rates that will be applicable on what? Our TTP. Okay, what's the rates? Very simple. For small, we have small companies and we have large companies. Small companies are small companies are companies that has below what? £300,000. Augmented profit, okay? Or large companies are companies that have above 1.5. Okay, then we have marginal company. I'm not going to ask you for the rates. Remember, I've told you, you are not allowed to use the rates as a rate. So when your company falls in between the profits, what do? You do the normal thing. That is what you do for what? The main rates, less marginal relief. Now, it is at this point that you have to be very careful. When you're solving any question for a company, and the company's accounting year does not coincide with what? The financial year. Automatically you do your use to financial year. What's the financial year? Wow. What's financial year? 31st March. If it is not 31st March, you should know that I'm using what? Two financial year. That's why in your paper you'll be given 3 financial year. So it is possible that you're using 3. You have to learn it. Look at the financial year that you're looking at. Do you get? Okay. And what are the instances when we have to adjust our limits? One. When you have short periods, I don't know, can we have the two together? Is it not possible for a company with short accounting period to have 2 assets or to have assets? It is possible. Do you get? This is just statement. Okay, from there we move to group, right? Now remember I've not talked about loss. I've not talked about basis of assessment. Okay, basis of assessment, hardly do you say it? Do you get? But that's notwithstanding, you have to learn it. I know students. What is this business? First year, I understand now. Second year, what is this? You look at it, you say business. If you have accounting period ending in the second tax year, how long? If it is long, the basic thing will be you start from the beginning, 12 months forward, 12 months backward. What's all this thing now? But don't worry, you have to learn it. Okay, then for loss. You have for losses for companies and for individuals, they are the same. Individuals, we have what? Current year loss. Carry back. How many years? 12 months. 12 months for an ongoing business. Okay? And please remember, we are now have restriction. Before now, we don't have restriction. The restriction now is what? The higher of 25,000, okay, 50,000 and 25% of our total profits. That's the maximum we can claim. Yeah. Okay, then from there we now have for an ongoing business. I mean, for a new business, that is a business that is just starting. If you any loss you make in your first 4 years of trade, you are allowed to relieve it when 3 years backward. Okay, starting with what? With the earliest. That's also what I want. You have to start with the previous year. Do you get? Okay, that's for that. Now, for a business that is seasoned, we have terminal loss relief for this person. Okay? The individual will be able to relieve his loss in the year of loss and what? 3 years backward. Now, starting with what now? The latest. Okay? That is that. Loss relief is very simple. The same thing I just said is also applicable for company. Well, with an exception for carry back loss relief for companies. Before companies can go back, you would have done what? Company must relieve what? In the current year loss first before going back. But for individuals, there is no rule that says that. An individual can go back and come forward. And an individual can also relieve from his what? Chargeable gain. Did you get? Okay, that's that. I have 5 or 10 more minutes. Finish up. Here we go. Let's pause there. CGT. What is capital gain? I'm taking the two together anyway. Capital gain is what? Is a gain that arises as a result of what? Making a chargeable disposal of a chargeable asset by a chargeable persons. Hope you know the definition of all those things. That means not all persons are chargeable. Not all disposal are what? Chargeable disposal. Not all assets are what? Chargeable assets. Okay, and I want you to know what are the instances where we use what? Dim process. Dim process. It is what? Dim process. Look at where you are going now. Okay, wait. Please. Now let me start. Remember the example I used? I used the example of land. Remember that young man standing in front of you then that wants to acquire land. You know, all those procedures that he went through before acquiring that land, later dispose of the land. Okay? Now, the actual amount he paid them was what? The sales process. Now I'm asking you, what are the instances where you have to do dim process? That is not the actual amount exchange. It's very simple. No. When you are selling, not as okay? When you are selling to a connected party, you go to the market and use the market value. Or when you are giving a gift outside, you're not receiving anything, but it's a chargeable disposal. What do you do? You use the market value, go to the market and use the market value. Or where the gifts are the type that you cannot determine the value, then go to the market. Use the words, the market value. Okay, then from there, we talked about what? Insurance process, when an asset is damaged or when it is what? Destroyed. Remember there are 2 instances. Okay? Then we talk about how do we do it? We might treat it what? As what? Part disposal, or we treat it the full way, depending on what you use the insurance process to do. If you use the insurance process to reset the asset, then you can, I don't want to use the word now, but you can, let me use it, roll over or carry over your gain as the case may be. Okay? Then we now move to release, right? Release. Business relief or CGT. What are they? We talked about rollover relief, right? What is rollover relief? You guys are tired. Is it because you are not writing? Don't worry, we'll soon write. We'll start writing now. I'm just warming you up. What's rollover relief? Rollover relief is the relief you get as a result of what? Reinvesting your proceeds. You've made a sales, disposal of chargeable asset. You now use the money to what? To buy another one. However, there are conditions which you have to satisfy. Which are what? What are the conditions for rollover relief? Both old and the new asset must be what? For business purpose. The asset could be what? Land, movable property, plant and machinery, any other thing. Then another one is reinvestment will have taken place 1 year before and 3 years after. Then the last one, it says, the gap between buying the old, bringing in the old, selling the old, and bringing in the new must not be what? Too long. Do you get? Now, how do you treat it all over the new? We use it normally. We use it we deduct it from the base cost of the new asset, depending on the nature of the asset. If the asset is a depreciating asset, you don't use it to deduct the base cost. But rather, what do? You defer the gain, you hold the gain. You don't do it. You hold the gain until when? If the asset is disposal, until the later of these three, when the asset is disposal, when the business is existing, then 10 years after. The one that comes first. Now, if the asset is what? It's non-depreciating asset, what do? You use it to deduct the base cost, remove it from the cost of the new assets to get the base cost of the new assets. And that is that. I will talk about loss for individual, for capital gain. How do you relieve loss? When you're bringing loss for, remember, you can only relieve your capital loss from your capital gain. Okay? Then when you're bringing any loss from the previous year to this current year, you have to relieve it to the extent that you preserve your annual expense. Okay? But if you make several disposals this year, you don't have to. If all the transactions occur this year, all the disposals happen this year, you net it off. Do you get it? You net everything off. But if you're bringing any loss from the previous year, when what you have in this current year is less than 10 now, what do? You leapfrog, you move to the other tax period. Okay. Then another thing. What else? Now let's talk about company, CGT for company. Okay, before I do, why now? Relief. I only talk about rollover relief, right? Entrepreneur relief. What's entrepreneur relief? I'm not going to write this down. You know it's you guys. Disposing your business asset or the business itself. Okay, you get your entrepreneur relief, but there are conditions. What are the conditions? At least you must have owned the asset for at least 1 year, and you must have been using it for business. And if this is what shares in a personal company, you must at least have what 5%, and you must be what an employee working full time in that organization. You see, this is where you get your church mark, 3 marks. You ask me, how do I get that 3 marks? What is so much? Okay, now how do you treat entrepreneur relief? It's very 10%, irrespective of what the taxpayer taxable income. You know the ideal thing. What do we normally use to determine the CGT rates? We use the taxable income of the individual, whether or not he has exceeded what the basic rates. We have 18, 28, or we could use the 2. Do you get? We could use the 2 depending. But when you're claiming entrepreneur relief, it does not matter. Whether the person has already exceeded 20, 32 and 10, does not matter. You just use the 10%. Okay? Another one. We talked about health over relief. Okay, gift relief, all over relief. Gift relief is a relief that you get as a result of what? Giving an asset. Like I said, when you give an asset, it's a chargeable disposal. Though you're not receiving anything from it. But they are saying they will compute a gain on you. Do you get? For giving an asset. Now, how are they going to compute it? That's not the issue. They will go to the market and use the market value of what? The assets that you've given. Do you get? Now, in that case, because you have not received anything from that person, no gain. No gain will be taxed. But it is possible for you to receive something, but receive, like I said, just little thing. In that case, it might result in the what? Again, the other thing, though, I don't know whether this one is there. We talked about incorporation relief. Didn't we? Incorporation relief. Ha! I said it's not parts. I will go through your question and you see that it's not there. Incorporation relief. It's a relief that you get as a result of what? Selling your personal company. Your personal company. As an unincorporated business. Converting it into what? A new business, which is now an entity that is registered. Now, okay, how the treatment will be dependent on the transaction. If you're still involved in the organization, maybe as a director or as a shareholder, you can get relief. We call it entrepreneurial relief. There are conditions as well. Do I need to state the conditions? And you state it. Okay, the consideration must be wholly or partly in what? Wholly in shares. That is, what you're receiving from the company must be what? Shares. You must not receive cash. If you're receiving cash, you will be taxed. Do you get? But you are selling your company, but the company is just giving you a share for selling. In that case, it's what? They qualify for what? Paper for paper acquisition. So you don't pay CGT on it. Okay, now for companies, the difference between CGT for companies and CGT for individuals. For individuals, we have CGT. We have chargeable gain tax. 18, 28. In the case of entrepreneur relief, we have what? 10%. But for companies do not have what? They don't have CGT, but they don't have chargeable gain. You can see it here. We are going to tax it. We are going to include it with other profit or income that will make up their what? Their TTP. Okay? But in replace, individuals have annual exempt, which is how much? 10.9. But companies do not have annual exempt. What do companies have that individuals do not have? Companies have what? Indexation allowance. What is indexation allowance? Thank you. You just what? You want to take account of the inflationary effect between the date of acquisition and the date of disposal. And why are you looking at me that way? Remember the movements. You know the movement and how to do it. Then another thing, once you've done that, then we can talk about shares. Shares for individuals and shares for companies. What are the share rules for individuals? Same day for individuals. For 30 days. Don't just tell me that. Is it within the next 30 days or previous 30 days? Tell me.
Within the next
30 days, then what? Shares in the pool. For individuals.
same day.
For companies. Okay, you are okay. Okay, that's that. Then we now move to another thing. For companies now, PPR. We talk about charter, yes. Charter, PPR. What's PPR? Principal Private Resident. What are the conditions? It simply means when you are disposing of your main residence, you're not supposed to be taxed. And you will not be taxed if only you can occupy the house from the date of acquisition to the date of disposal. Is that possible? Yes. They understand that it is not possible. And that's what we have to call dim occupancy. You can see, madam, it is the dim occupancy that you're replacing with dim crossing. I know you've read and there are a lot of things on your head that want to pop out. Please put them in order. Okay, dim occupancy. Okay, what's we are giving the instance for dim occupancy. Dim occupancy. At least that one is just there. Yeah.
Any 4 years outside the on official
On business trip, okay.
Any
period outside the
Okay, wait, let me tell you. The last test is more like you said. Let's start from the no. Then, any number of years outside the UK for employment reasons. Okay? The 4 years we talk about is within the UK for either self-employed or employment reason. Then any three now is for any reason. And before you can claim this any reason, you have to what? Come back to the house before disposing the house. Are we good? Okay. Then we'll talk about letting relief. Maybe in all this period, you let out your property. The one that falls within the chargeable period, you can put your letting relief on it as well. Okay, that's that. I can pause there. VAT. But my time is 11:20. So I need to finish up before maybe 1140, thereabouts. VAT is an indirect tax, and it's a tax on turnover, and it's being borne by who? The final consumer. However you want to look at it, it is tax on turnover. Because the purchases you made, it was some other person's sales, right? Do you understand? The purchases you made was on some other person's sales. And when you now do your own, you want to sell, it's also on your sales. You can see it is what? Tax on turnover. Okay. Now I'm going to look at the inputs and the output part. Remember, I've told you, don't look at it from cash aspect, but you should look at it from what? The goods. Okay, which is what? Now, the tax you paid on your purchases, what is it? You're bringing in goods. I say you should look at it from the goods. You're bringing in goods, which is what? Inputs. And the one you charge on your sales, you're selling your goods. It is what? Output. The difference is what you give to what? To the HMRC. It's as simple as that. Then we have what? 3 types. Basically, we have 2. We have taxable supply and exempt supply. Taxable supply and exempt supply. For exempt supply, when you're making an exempt supply, you are not a taxable person, so you cannot reclaim any output VAT. Okay? But when you have a taxable supply, under taxable supply we have 3. But majorly you should be concerned with 2, but we have 3. We have standard rated, we have zero rated, and we have reduced rates. Okay? What's the reduced rates? Just tell me the rates for the reduced rates. It's 5%. Okay? The number on the sales that we'll be making. Is that? You have the reduced rates. Okay, we don't normally use rates on some certain goods. Like chicken cassettes. We have several supplies. Cassettes. Go and look at it. Okay. Then, from there, remember we said for taxable, what's the standard rate? The standard rate is 20%. The zero rate is 0. We don't normally apply it. But once you understand that this is what 0, you don't have to apply it. Okay. Now, before a taxable person can reclaim input or charge back, as the case may be, you have to what? Register. Do you get? You have to do what? You register. That means you have 2 types of registration. We have compulsory registration and what? Voluntary registration. Okay? For compulsory registration, what is that? It simply says we have 2. We have historical tests and we have future tests for compulsory. Okay? For historical tests, you look at your taxable supply in the last 12 months if it is more than what? £79. Okay? 79,000, yes, £79,000. If it is more than that, what do? You have 30 days period to notify HMRC. The HMRC will now register you when? A day after. It's a day after. After the 30 days, a day after. Then for the future test, you just look at 1 month ahead. You know, this is festive period. People have been making supply, they've been making demand, orders. Then you could tell that say in the next 30 days, my supply will exceed 79,000. What do I do? Notify HMRC. We have 30 days period to notify them, but HMRC will what? They will register you on the 1st of the month. You are notifying them in what? Retrospectively. Okay, that is that. And for voluntary registration, from the word voluntary, it simply means you're doing it willingly. Nobody is compelling you to come and do it. You're not being compelled to do it. That means, even though your taxable supply is not up to 79, but you want to register. And I told you, majorly it is what? For somebody that is making a zero-rated supply. Majorly. Let me tell you the implication. Someone that is making standard-rated supply will be charged VAT and can charge. So it is compulsory for that person to do what? To register. Somebody that is what? Making a zero-rated supply would be charged but cannot charge. But it is not compulsory for them to register. What's the implication of registering? If this person registered, you'll be able to reclaim the input VAT. If you did not register, you're on your own. So you will now look at the costs and the benefits. What is the cost of setting up, the cost of registration against the input VAT that you want to recover? Now, what is the long-term effect? You only do this once, but recovering is every time you keep making sales. So you'll be recovering. So you have to look at that. For somebody that is making an exempt supply, you are not required to register, whether compulsory or voluntarily. You will be charged and you cannot charge. Are you there? Okay, what is the implication of... You cannot recover. Okay, yes, I didn't have that. You're hot, I said it. You're hot. You know that I'm opening a page on your head, and I'm not reading. You don't get to the place and not jump. So you come in like, I like that. Okay, now... Another thing, what other thing? Consequences of making deregistration. You can deregister. For deregistration as well, we have compulsory and what? Voluntary. Okay? For compulsory deregistration, the difference is just that you are no longer, neither do you intend to make taxable supply. Do you get? That's voluntary deregistration. Okay? Now, for this compulsory, that's compulsory. Before the voluntary deregistration you are still making taxable supply. But it's just that HMRC are able to emphasize that your taxable supply in the next 12 months will not be up to 77,000. Then you will have to do what? Deregistered. And, okay, this is outside the scope. Don't let me go there.